who can afford a $20 million for 1 ounce of gold? How can the COMEX have 1 ounce of silver when there's been $10 arbitrage for months? They use those paper contract markets to manipulate the visible price. They don't say this is a spot gold contract. They refer to it as gold or silver. Hey, those trading revenues at JP Morgan Chase, those trading revenues were awesome. Your deposits fund their trading. Well, what can you buy with $1 today in terms of loaf of bread? Not even a quarter of a loaf. But here's the problem with cash. This is why they want to get rid of cash. Same reason why they wanted to get rid of gold, in that it created restrictions around how much debt they could create. This is a debt instrument that does not pay or charge interest. It charges inflation. So where that debt used to push those asset prices up, well now, okay, all of that new money is sitting here in this stock. Lynette, serious question. How can the COMEX have 1 ounce of silver when there's been $10 arbitrage for months? This makes no sense to me. I'm beginning to think the COMEX is neighbors with Fort Knox. Yeah, they are. And actually, that was one of the holes, and I told you this, that I promise you, because I realize that you guys don't really understand the spot market. So we're talking about COMEX. So next week, I promise you, and we may even just do that on the live, where I'm going to show you the truth about the COMEX and how you know that it's the truth. And remember, I give you links to everything. So follow those links, because you're right. It makes no sense, but it's simple, really, because the COMEX is all about contracts, whether it's one contract that controls 500 ounces or 250 ounces. And of course, they want to democratize the markets, which means transfer the risk to you. You could buy 1 ounce contracts now, right? So if you can just have 1 week worth of patience, unless something major happens between now and next Tuesday, then I will explain it, and I will show you, and I will give you links so you can do your own follow-up with that. Because this is really important for you to know. How many times can you be lied to and you do not know the truth?
Yeah, exactly. And it's just, like you said, it's a manipulated paper market. If there's nothing physical backing it, they can rehypothecate it, they can suppress the price, they can do whatever they need to do to simply just, serve their best interests, not ours.
A $10 arbitrage gap shouldn't exist in a fair market, yet here it is lingering in plain sight. As Lynette Zang points out here, the COMEX structure is built on contracts, not actual metal, which allows leverage to distort real supply-demand signals. When retail is pushed into smaller, democratized contracts, risk is quietly shifted downward while liquidity is manufactured upward. Historically, sustained arbitrage gaps signal either delivery stress or synthetic pricing pressure, and neither is priced into mainstream narratives. This raises a critical question. Are investors trading metal or just exposure to it? Next, Lynette Zang unravels how these paper mechanisms actually suppress price discovery.
Exactly. And you have to be smarter than them. And that is our goal. My personal goal for years has been to translate this financial noise into understandable language so that you can make educated choices that put your best interest first. And especially if you're going to have intangible assets. So whether those are stocks, bonds, mutual funds, ETFs, cryptocurrencies, all of that is intangible. If you're going to have that, you need some hard assets, sound money to properly diversify that portfolio. So yeah, this cannot be hacked, but what they do is they use the COMEX, going back to the first question, they use those paper contract markets to manipulate the visible price. They don't say this is a spot gold contract. They refer to it as gold or silver, and they can make as much of it as they want to until they can't. Remember, this whole thing is a big con game. And every con game requires confidence. And that confidence, I haven't been able to really bear with me because I did just get back a couple days ago. But it looks like small business confidence is down. It hasn't broken the levels yet. I did glance at that. Consumer confidence, inflation expectation, all of these things are working against the system, but they're all telling the same story.
Yeah.
And that's really that the public is losing confidence.
Right. Yeah. And I mean, we're not even that far into these rising gas prices, which affects all of that too.
Confidence is the only thing holding this entire structure together, and the cracks are starting to show. As Lynette Zang points out here, when assets are purely intangible, pricing becomes dependent on perception rather than underlying reality. Small business confidence and consumer sentiment have both trended downward into 2026, while inflation expectations remain sticky. This is not a stable backdrop. If paper markets can expand supply infinitely, then price signals lose meaning, especially for long-term investors relying on fundamentals. The real risk isn't volatility, it's mispricing of reality itself. Next, Lynette Zang discusses how declining confidence could trigger broader systemic shifts.
And yeah, we'll have to see how that continues to go. I mean, it's a whole thing, like when we're at the end of a currency's life cycle, how everything plays out. It's not just a snap of the fingers overnight, it takes time.
Right. And no matter what happens, even if the war against the Ukraine between Russia and Ukraine was over, if the war in the Middle East was over, the damage that's been done to the infrastructure and to the confidence, that doesn't go away just like that. This is a trading market. This goes back to the other question about the COMEX exchange, but even all the NASDAQ, the S&P 500, all of these exchanges, what are they moving on? I mean, when I looked this morning, they were very close to all-time highs.
Right, yeah.
What difference does it make? And hey, those trading revenues at JP Morgan Chase, those trading revenues were awesome. We'll be looking at the OCC report on derivatives.
Oh, yeah.
With all those trading revenues, which are what banks count on to make their money. This is just a big trading market. Don't be fooled by the lies.
Yeah. The Q1 report for 2026 of the OCC is very interesting because you start to see how these banks actually operate with one another. But that's really where the interesting part comes in. Yeah, they could they have our deposits, but how do they deal with one another? And how they really make their money, right? How do they really do that?
But you brought up their deposits, right? And I think it's Citi, but don't hold me to that. It could be PNC. Somebody that I was listening to and I grabbed it, I just haven't had a chance to look into it, was looking at buying, one of the commercial banks was looking at buying a large regional bank for its depositor base.
Wow.
Because that's cheap funding for them. Your deposits fund their trading.
Yeah.
Right? And they can create as many of these contracts, an unlimited amount of contracts. There's no limitations. In the physical world, there are limitations, and I don't care how much there are.
Right.
There are still limitations. So just don't be fooled, because the cryptocurrencies and Bitcoin, I believed it from the minute I saw it, and I believe it today, is a Trojan horse. When they make these transitions from this current debt-based paper system into a fully digital system, which that's the rendition of a Bitcoin. It's garbage. It's designed to look like this.
They're trying to trick you with this to think, oh, look at it, it's gold, and you can touch this coin, but
it's not real. That's just a physical representation, right?
It's nothing.
Don't be fooled. It's a Trojan horse. Yeah. Absolutely.
Markets hitting highs while structural risks build underneath is a classic late cycle illusion. As Lynette Zang points out here, trading revenues, not productive growth, are increasingly driving bank profitability, especially visible in recent 2026 earnings reports. When deposits become cheap fuel for derivative activity, the system prioritizes churn over stability, and that's rarely sustainable. Add in unlimited contract creation, versus finite physical supply, and you get a pricing system detached from reality. Investors should question whether index highs reflect strength or just liquidity concentration. Next, Lynette Zang unravels how these internal banking mechanics really generate profits.
So, Kenneth, that's what it says on here. So, I was just reviewing BlackRock's capital deployments for Q1 of 2026, and there's a huge glaring contradiction on their balance sheet right now that every steward in charge of a legacy needs to look at very closely. Make sure that you send that to me and I'll pull it up and I'll take a look at it too. If you follow institutional money, you know that over the last 18 months, BlackRock has executed one of the most aggressive buying sprees in financial history. AES Corp for physical energy infrastructure, GIP for global infrastructure, Elm Street for their commercial real estate, and HPS Investment Partners. In total, they have taken, look at what a good job you've done. Thank you so much. In total, are these your notes? Mm-hmm. Oh.
That's okay.
Go for it.
No, go right ahead.
No, you keep going because that's great. I'm like, thank you for doing all of this great work.
Yeah, no, so it just was to show, because it's to your point with BlackRock and assets under management and why these companies buy other companies, how they just look at the balance sheet to add to their own position. It's not about helping us, right?
Right. Yeah. And it is also taking on a lot more debt and a lot more leverage.
Aggressive expansion often looks like strength until you examine what's funding it. As Lynette Zang points out here, BlackRock's recent acquisition spree across infrastructure, real estate, and private credit signals strategic positioning, but also rising leverage exposure. When firms prioritize balance sheet growth over organic returns, it raises concerns about future earnings quality, especially if financing costs stay elevated into late 2026. Institutional capital isn't chasing opportunity alone. It's securing control over real assets and cash flows. For investors, this shifts the risk from visible markets to opaque balance sheets. Next, Lynette Zang discusses the hidden risks behind this accumulation strategy.
And when things go south, like we've seen recently with BlackRock, right? And all of this private equity.
Correct.
And their goal is to be the private equity. They want to own private equity, just like, to your point, they own everything else, right? Well, who can afford a $20 million for 1 ounce of gold? Probably either somebody that writes the laws, or they can certainly influence those that write the laws.
Right.
And so that's the classification. You don't have to spend $20 million on a coin. I certainly don't do that.
Yeah.
But you want to be in that same classification. Or at least that's where I want to be and where you want to be.
Yeah, absolutely. Yeah, like it's all about just, the safest way possible that you can hold your wealth, and then it doesn't matter what happens out there with the bullion or overt confiscations or taxation on however the government wants to get that from you.
Yeah, exactly.
Yeah.
So Understanding Truth 10 asks, how much would an ounce of gold buy during the Great Depression, please? You talked about this once and I missed it. Well, I don't think I can easily pull this up, but during that period of time, an ounce of gold had a fixed price before the confiscation of $20.
When asset ownership starts aligning with political influence, markets stop being truly free. As Lynette Zang points out here, the idea of $20 million gold isn't about price prediction. It's about access, classification, and who benefits from systemic shifts. Historically, wealth preservation favors those closest to policy making, especially during revaluations or crises like the 1933 gold confiscation. The real takeaway isn't chasing extreme valuations, but understanding how rules can change overnight and who gets protected. For investors, this means focusing less on price targets and more on positioning within the system itself. Next, Lynette Zang discusses how historical gold pricing reveals deeper monetary shifts.
A family could live with one wage earner with the average wage being $800. We are actually getting paid less in terms of ounces of gold today than, even though the average wage I think is like $68,000, than we were in 1913. So a family of four could live quite well, and I'll, if I make a note of it, I don't think I have any pens in this drawer. Tom, can you make a note to bring the table next time, and I'll update it and I'll show you. Yeah. I'll show you. Or you can call up and one of the strategy specialists can also give it to you as well, right?
Yeah, absolutely.
You have access to all that stuff.
Yeah, you just send it over like, however you need to get that information. But to your point, it's true. We can buy less gold with our wages now, today, in 2026 than in 1913.
Right. You know what I can remember off the top of my head? This is a $1 gold coin. It's a 20th of an ounce. And in 1913, I could buy 11 loaves of bread with this. Well, what can you buy with $1 today in terms of loaf of bread? Not even a quarter of a loaf.
No, yeah.
Probably about I don't know,
slice
maybe.
or two? Yeah.
Something like that, right? So that's a good example of it. $1, what that would buy in terms of bread
Right.
yesterday, what it'll buy today, there you go. That's all loss of purchasing power. But this little $1 coin, I'm not quite sure what it's going for. Its value is right now, but even if you took spot divided by 20,
right.
you would be able to buy a whole lot more than 11 loaves of bread with this 20th of an ounce of gold.
Wages look higher on paper, but purchasing power tells a very different story. As Lynette Zang points out here, comparing income in gold terms exposes a long-term erosion that nominal salary growth hides. In 1913, one small gold coin bought 11 loaves of bread. Today, a dollar barely buys a fraction, highlighting over a century of currency dilution. This isn't just inflation, it's structural debasement that compounds over decades. For investors, focusing only on income growth without measuring real purchasing power can lead to false security. Next, Lynette Zang shows how this loss of value connects directly to monetary policy decisions.
But here's the problem with cash. This is why they want to get rid of cash. Same reason why they wanted to get rid of gold, in that it created restrictions around how much debt they could create, because this is a debt instrument that does not pay or charge interest. It charges inflation, right? So that was the hidden game here. And then that's the next thing that they can do if we are in a full digital system.
Right.
Right? So that can keep the theft going, because here you have limits on how low you can actually push interest rates. But once we're digital, they can go out so far that you don't see that erosion. Just like you think inflation is a monetary phenomenon, it's not a monetary phenomenon. It is a fiat money phenomenon. And it was always positioned for the central banks to control inflation via the raising and lowering of interest rates.
Right.
That was always just part of it. You want to stimulate and create more inflation, you drop interest rates, more people borrow and spend. You want to slow down that inflation, you raise interest rates, fewer people borrow and spend. The real problem is that, especially since the financial crisis, the amount of money that they printed and pushed into the system, now it's just about the liquidity flows, right?
The push toward a cashless system isn't just about convenience, it's about control over financial limits. As Lynette Zang points out here, removing physical constraints like cash or gold gives policymakers far greater flexibility to expand debt and manipulate rates beyond traditional boundaries. Since the 2008 financial crisis, global liquidity injections have surged, yet real economic productivity hasn't kept pace, creating a growing imbalance. When inflation becomes embedded in the system rather than cyclical, traditional rate tools lose effectiveness. Investors should recognize that policy flexibility often comes at the cost of currency stability. Next, Lynette Zang unravels how liquidity flows now dominate market behavior.
So where that debt used to push those asset prices up, well now, okay, all of that new money is sitting here in this stock, and then if it flows over here, then that goes up and this drops pretty dramatically. Yep. Look at the level of volatility in there, right? So that means that the raising and lowering of interest rates is not effective anymore. That's not controlling the inflation. It is now the flow of funds, which means trading.
Yeah, and that's just another point of showing where we're at in the currency's life cycle. When those things no longer work, you're getting now closer to where you're losing all purchasing power, and then you've got those volatility, movements.
And control.
Yeah.
Right? And so when the central bank or the government loses control, what do? They go harder, they get more aggressive with everything.
Right. Yep.
But the problem with central banks is the only tool they have is to print money. And any of the money that they print now, it's like pushing on a string. It does not have that impact that they need. And that's why we have to do something different.
Yeah.
And that's why we have to protect ourselves. Because they're not protecting us. They're putting us in harm's way.
Yeah. Very true.
Volatility is no longer a side effect of markets. It's becoming the main driver. As Lynette Zang points out here, capital is no longer responding predictably to interest rates, but instead chasing short-term flows across assets. This shift weakens central bank control, especially as rate hikes or cuts fail to anchor inflation or stabilize markets as seen through 2024 to 2026 cycles. When liquidity moves faster than fundamentals, price discovery breaks down and risk increases silently. For investors, this environment demands more attention to capital rotation than traditional indicators. Next, Lynette Zang discusses what happens when central banks lose effective control.
As individuals, we are absolutely the right size to fail.
Yeah.
What can we do? Nothing. But if we come together in community, both local and global, now they have to deal with our demands. And if we get 3% to transition into sound money, silver, and gold, but gold is the primary currency metal, we want it redeemable or we will not comply. And if you're independent, you have that voice.
Yeah.
If you're not independent, if everything's in the system, you do not have that voice.
Right. Yeah. Really comes down again to the strategy. That's what it's all about.
Yep. So I probably need to do this for Ernest. Hi, Ernest. Rock and roll hoochie coo. I own my home and have basically zero debt. When they revalue the currency, what strategy applies to me? Accumulate land, property, hoard more AU or AG? So it becomes about income producing assets, which is still part of the strategy, right, even if you don't have to deal with any fixed rate debt, which is just exactly a great position, to be in. So then you execute the rest of the strategy. And again, it goes back to having something that's customizable.
Individually, investors are exposed, but collectively, behavior can shift market dynamics. As Lynette Zang points out here, even a small percentage moving toward hard assets could challenge the current financial structure. Historically, systemic changes often begin with minority adoption before accelerating, especially during periods of declining trust. The emphasis on independence highlights a key risk. Assets held entirely within the system may be subject to policy shifts, restrictions, or revaluation. For long-term investors, diversification isn't just about returns, it's about optionality and control.